Good day, everyone. My name is David Williams, Executive Director of the United States Association for Energy Economics. It gives me great pleasure to welcome you to today's webinar entitled Taking a Look Ahead, the Long-Term Impacts of a Crisis on Oil Demand. We are grateful to our moderator, Dr. Robert Kleinberg from Columbia University Center on Global Energy Policy, and our keynote speaker, Dr. Marie Fagan, Chief Economist at London Economics International, for addressing this timely discussion. First, a little bit about the United States Association for Energy Economics. We are the largest affiliate of the International Association for Energy Economics and provide a forum for the exchange of ideas, experience, and issues among professionals interested in the field. The organization produces 2 professional journals, a newsletter, and holds conferences and virtual presentations along with a host of other products and services you can find on our website at www.usaee.org. If you're not already a member of the association, we welcome you to join. A few housekeeping matters in regard to today's webinar before I hand things over to our moderator. First, this webinar is being recorded for those that cannot participate in today's live event. If you have any questions for our panelists, please click the Q&A button at the bottom of your Zoom window and type your question. We've allocated sufficient time at the end of the webinar to address your questions. And now I would like to introduce you to our moderator, Dr. Robert Kleinberg from Columbia University Center on Global Energy Policy. Bob, over to you.
Thank you, Dave. It's really a pleasure to introduce Marie Fagan, who I've known for a number of years, who I've in fact met through USAEE. Marie is the chief economist at London Economics International, based here in Boston. She has conducted research and consulted in energy economics for over 30 years. In the oil and gas sector, her work has spanned exploration, development, production, transportation, and refining. She also has deep expertise in North American gas and power markets, including both regulated and deregulated systems. Dr. Fagan has advised C-suite industry clients, buy-side and sell-side financial clients, regulators, and public interest groups. She serves as an expert witness in litigation and regulatory matters related to oil, gas, and electric power, and publishes in academic and industry journals. In fact, Marie and I are co-authors on an article that just appeared in the IAEE Energy Forum just this last week. From 1996 to 2014, Marie was with Cambridge Energy Research Associates. Prior to joining SARA, Marie was an economist with the Energy Information Administration. She holds a PhD in economics from the American University in Washington, D.C. Speaking for myself, I've worked with Marie on several projects on which she has served as the adult supervision and has done a very good job of that. Marie's talk today is titled, Taking a Look Ahead, the Long-Term Impacts of a Crisis on Oil Demand. Marie, please go ahead.
Thanks very much, Bob. Yes, and thanks to Dave, London Economics, we're very pleased to be part of this nice series of webinars that USAEE has been holding over the past few months, kind of keeping us in the energy space kind of all together during this crisis when we are physically apart. So we're very pleased to be part of this. Let me share my screen so we can get started. And okay, Bob, can you see my slides?
Yes, I can.
Okay, if you can see them, so can everyone else. Okay, right. Thanks. So just to get started then, we obviously know that oil demand collapsed as a result of the shutdown of the global economy based on responding to the coronavirus. And the decline for 2020 is projected by the IEA to be 7 times the size of the decline that happened as a result of the global financial crisis about 8-10 years ago. But we know that eventually the economy will recover. But what about oil demand? That's what we're going to be looking at today. So just to give you an outline of where we're going, we'll have a brief introduction, and then we'll start with a look backward. We have a couple of slides to ground us in history and give us perspective. We've seen crises in the past, and they have impacted oil demand, and how did they play out? So we'll look at that. Then we're going to focus on measuring the impact of economic activity on oil demand. That'll be sort of the econometric meat of this presentation. And then in section 4, we'll take a look forward at what this history and the measurement of the impact of economic activity means or could mean going forward. And finally, though we won't present it, there is an appendix with some technical details and some information about London economics. So when the economy recovers, what should we expect from oil demand? We know that global demand collapsed owing to the COVID-19 pandemic, but the question is, to what degree will it come back? So, we have a few bullets here. A lot of folks have been thinking about this. The lockdowns have been temporary. Some of our states in the US are coming out of lockdown, faster than others. But even though it's temporary, it could have permanent repercussions. So our friend Amy Myers-Jaffe noted that in the US, for example, we actually waste about 6 billion gallons or 390,000 barrels a day of gasoline just sitting in traffic because of traffic congestion. So if we're not having to sit in traffic, if people are working from home, that piece of demand could be much lower. But even if the economy fully recovers and we all start going back to work, or at least folks who need to show up at the office go back, travel to work, as you can see by this pie chart, the data from the US Department of Transportation, it's only 21% of vehicle miles traveled. So if you look at what's about half, these are discretionary trips, home, shopping, errands, things like that, things that people have been dealing with, for example, by shopping online and doing things more remotely. And they may or may not want to go back to getting in the car, to taking care of all this business. But on the other hand, if people start going back to work and want to avoid public transportation, or maybe public transportation's only allowed to operate at a lower capacity, in the near term, you might see a bump up in the use of cars. So it might be sort of possibly a false dawn for demand for gasoline. So we don't know how this will play out in the long run. If we think of the long run as when things return to normal or return to a new normal. But we do have data from history to help us envision the future. It'll help us, when we look at it, to understand the drivers of oil demand, because it addresses questions about how the structure of the economy generates demand for oil. And that's important. We know that demand has been hit, for example, in certain refined products harder than others, for example, jet fuel, because the lockdown has particularly hit air travel as well as road travel. So just to give you a perspective on the purpose and the approach, what generated this research to measure the drivers of global oil demand, LEI, London Economics, conducted an in-depth study of oil supply and demand shocks since the energy crisis of the 1970s. So we had 40 years of data to look at how demand responds after a crisis. And the purpose of the research, we did the research for Columbia University Center on Global Energy Policy. CJEP was interested in looking at income and price elasticities of demand for crude oil and refined products. So we studied both crude oil and refined products. And just to give you the economist's definition of income and price elasticities, that just means, how does oil demand respond to a change in GDP? How elastic is it? That's the income elasticity. And how does oil demand respond to changes in prices? That's price elasticity. Those are just the technical economic terms. So this research for CJEP provided the foundation for this presentation. And our approach was to examine data for oil demand, oil prices, and GDP over, as I said, 4 decades. We looked at 25 OECD countries, 18 non-OECD countries, and 5 oil-producing countries. So we looked at data trends. We developed an econometric model because we wanted to identify separately the impact of economic activity versus oil prices. And econometrics allows you to tease out the various impacts of a number of drivers, so you can isolate which drivers impacted demand in what their impact was as far as size. So there's a lot of econometric detail, but I wanted to at least start with the key takeaways before we get into the detail. So the key takeaways from our research is that even though there's been decades-long growth in global crude oil demand, the rate of growth has slowed. So it's still positive, but it's slowed over time. That's because the oil intensity of economic activity has declined. By oil intensity, we just mean the barrels of oil per unit of GDP. So that number's gone down over time, but it didn't decline in a steady way. There wasn't a steady erosion of oil demand per dollar of GDP. Instead, it happened in several step changes. And we found sometimes it happened in response to an energy crisis. In other cases, it was the result of structural changes in the makeup of economic activity, both of which we're probably seeing in our situation now. And what's important is after each step change downward, oil intensity didn't recover. The barrels of oil per GDP didn't recover even after many years of economic growth. So the long-term growth in demand was at a slower pace than it was before the crisis. And that's where it looks like things will be going for the long term after this crisis. We'll talk about that. Long-term demand growth will likely be at a slower pace than before the crisis. So we promised to look backward to ground us in history. So let's take a look at this oil intensity of the global economy. And what we see in the chart, and we'll go through these eras, but it wasn't a steady decline. It was what we can call a descending staircase. So when we say oil intensity of GDP, it's just the barrels per day per $1 million of global GDP. And we normalize global GDP to get rid of inflation, and we're using 2016 dollars. So if you think about what happened in history, let's start with this sort of first section, starting in 1976. That's right about the time of the first energy crisis back in the 70s. And how much oil did it take to produce $1 million of global GDP in 1976? You can see from the chart, that was about 2.6 barrels a day per $1 million of global GDP. And then, of course, the first Arab oil embargo had been in place since about 73, 74. That drove oil prices up, contributed to a global recession. And then the Iran-Iraq war in 79, 80 pushed oil prices up further. So you can see that between 76 and 80, the oil intensity of GDP declined in response to the oil price shock. It fell from about 2.6 barrels a day to about 2.1 in 1980. So two factors were at play in this crisis. You had a recession, which reduces demand, and we had high oil prices, which also reduces demand. So that's what we see as the first stair step. And then you have this period where oil demand per GDP, oil intensity, seems to have recovered in about a 4 or 5 year time frame to just under 2.4 barrels a day per $1 million of GDP. And seeing this, the oil industry might have breathed a sigh of relief, but that recovery was really just a statistical result. It showed up because the recession was so bad that the slowdown in the economy was greater than the slowdown in oil demand. So it looked like the intensity of oil demand was recovering, but it was just that the economy was doing so poorly. And you can see that that recovery was short-lived. It only went till about 1984. And once the global economy got back on its feet after 1984, we started to see this next stair step down. So oil intensity started to decline as the economy recovered. And then we had this long period of low oil prices. That was about from 86 to 2002. And that supported oil intensity somewhat, kept it from falling too much further. But when you look at it, even over this 16-year stretch, oil intensity didn't recover to anywhere near the levels of the early 1980s. And in 2002, it was only about 1.7 barrels a day per $1 million of global GDP. And then starting in 2002, we saw the third step down. This was driven by non-OECD countries. We'll talk about that in detail in another slide coming up. And then beginning in about 2012, it started to look like the decline in oil intensity had leveled off at about 1.3 barrels a day per $1 million of GDP. And that's more or less where we were before the pandemic hit. So just to step back from this and summarize, what this history lesson teaches us is that these declines in oil intensity, whether they're driven by high oil prices or structural changes to the economic world, which we'll talk about in a little more detail, they come in chunks, in stair steps for the oil industry. And the intensity, even after many years, doesn't recover to previous levels. So we promised a closer look at some of these drivers. So, as I mentioned, the stair-step declines were driven by structural changes in the OECD countries and the non-OECD countries. And that's illustrated here. Here we're looking at intensity, oil consumption per unit of GDP. And you can see that the gray line at the top, those are the non-OECD countries, including countries like China and Korea before it joined the OECD. And they drove the decline in oil intensity in the last couple decades, particularly after 2004. And that's when their economies started moving away from energy-intensive manufacturing towards more service economies. Earlier in the period, you can see that orange line, the OECD countries, those countries' oil intensity started declining in the mid-80s, and a lot of that was in reaction to the high oil prices of the 70s, and not just high prices, but fears of running out of oil. You saw, for example, in the United States, implementing corporate average fuel economy, CAFE standards for cars. Europe also, standards for cars. Europe also has higher gasoline and diesel taxes, et cetera. So, and those economies also started shifting from manufacturing to less energy intensive service industries sooner than the non-OECD countries. So the OECD countries led the way for the first, or let's say the second, the middle stair step with their own declining oil intensity, but the structure of the non-OECD countries kicked in quite a bit later with their changes, which also drove this last or most recent stair-step decline in oil intensity. Okay. So that's our look at history. It's informative, but we really do need to delve more deeply to be able to measure the impact of economic activity on oil demand to determine what economists call the income elasticity of oil demand, meaning if GDP rises or falls by 1%, what does that do to oil demand? So we want a quantitative measure. So let's turn to that. So again, we're talking about the income elasticity of oil demand. And the reason you need to look at it carefully using econometrics is because at the same time that GDP is growing or not growing, if you're in a recession, there's other factors, especially the oil price, which can impact demand. And we know oil prices are volatile. They're closely watched by both consumers and producers. There is no consensus on exactly how much impact oil prices or economic activity each have on oil demand. And there have been decades of economic, econometric studies which have provided a variety of estimates. And these estimates depend on the time period you're looking at, the set of countries you're looking at, et cetera. For this research, we covered 40 years of data and 48 countries. We wanted to be as comprehensive as possible. And I mentioned earlier, we also looked at various, the same drivers for refined products. We looked at gasoline and diesel, but today we'll just talk about the crude oil side of it. So I mentioned crude oil prices are volatile, so we need to account for them. We need to account for their impact on demand. Oil prices, as we know, cycle through ups and downs. So here we just have a look at this to remind ourselves, as if we needed reminding, that oil prices are volatile. We have the Brent crude price, and we have the yellowish boxes. Those are supply shocks. The blue boxes are demand shocks or demand trends. So you can see, back in the 70s, we had the energy crisis. That was a supply shock, took supply off the market. But those high prices incentivized non-OPEC supply. The North Sea ramped up. They knew there was oil in Alaska, and they finished building the pipeline and brought that oil to market. Mexico started to become a large oil producer. And eventually, that increase in non-OPEC supply started to reduce prices to the point where Saudi Arabia was tired of supporting the market by keeping their own production off the market and supporting prices. And they opened the taps in '86, and we saw a strong price collapse then. And then, as I mentioned, we had this period of fairly moderate to low oil prices. We had a bit of a demand shock in '97, '98 with the Asia financial crisis. But then after that, growing economies, strong economic growth over a 10-year period. It was considered sort of the long upcycle. Gradually rising global demand started pushing prices up. And then you can see a demand shock. We had the global financial crisis, prices plunged, but recovered quickly as the economies recovered. But again, with these high prices, over $100, that was a strong incentive for non-OPEC supply, particularly in the United States, where we developed very cost-effective at $100 and even lower, cost-effective shale resources, particularly in the Permian, West Texas, the Bakken Shale, North Dakota. And there again, with this strong increase in supply, we had prices decline dramatically in 2015-16, recover a little bit with OPEC shoring up the market. And then, of course, that leads us to our recent price declines from the demand shock, from the COVID-19 lockdowns, and then cutbacks in for economic reasons in non-OPEC, and then OPEC plus holding back production to support the market. So it's a roller coaster, a highly volatile market. So because there's so much change in oil prices, you need to use econometric analysis to isolate the impacts of the economy compared to from the impacts of changes in prices on demand. And we have some details of the econometric model in the appendix for folks who are interested, and I'll also give you the information where you can find the article if you want to look at all the details of the econometrics. But for the presentation, we'll just focus on the results. So what you're seeing here, our headline is the impact of economic activity is lower now than in the past. So there's a lot on this chart, so let me walk you through it. So we have two things that we looked at in the econometrics. We looked at the income elasticity. We've got the chart on the left-hand side. We looked at price elasticity. And we had 4 sets of data. So look at the income elasticity side. We have OECD and non-OECD, separate models. And we split the data for the first 20 years of historical data, which is 77 through 96, and then the second 20 years of data, 97 through 2016. So what does this tell us on the left-hand side? Remember, elasticity is the percent change in oil demand from a 1% change in GDP here. So from 77 through 96, both OECD and non-OECD countries had a higher income elasticity. In other words, when GDP changed 1%, let's say it went up 1% in OECD countries, in the blue bar in 77, 96, oil income elasticity was 0.5. So a 1% change in GDP led to a 0.5% change in oil demand. And for non-OECD, that blue bar, a 1% change led to a 0.7%. It was a higher elasticity. Those economies were more dependent on oil, and when GDP went up or down, their change in oil demand was larger. But look at the orange bars. For both OECD and non-OECD, the income elasticity of oil demand is lower the past 20 years than it was the first 20 years of the data. That's that stair step down that we're seeing. So, for example, a 1% change in GDP is about a 0.45% change for OECD, and it's now about the same for non-OECD. So those countries, which had been very energy intensive, their economies look a whole lot more like OECD economies now when it comes to how they're using oil. So that's the income elasticity. So now let's look to the right for the price elasticities of demand. So the first thing you notice is all those numbers are negative. They're below the zero. And that makes sense because usually prices and demand go in the opposite direction. So if prices go up, demand usually goes down. People want less of something when it's more expensive, which means you get a negative when you do the analysis. So that makes sense. And we can see, again, like the income elasticity, the price elasticities in the earlier period were much larger. These economies responded much more strongly to a price collapse by using more oil or a price increase by cutting back than they do now. And in fact, for the non-OECD, the impact was very small. And it's, as we say in econometrics, it was not statistically significant. It doesn't look like those economies are really responding to changes in oil prices. So a very low oil price is not going to stimulate that much demand to help oil demand recover. It's maybe not good news for the oil business because this elasticity is so much smaller. So our big takeaway then is because price and income elasticities are both smaller than in the past, they matter less to oil demand. You're not going to stimulate oil demand that as much as you did in the past when the economy recovers, and you can't stimulate it as much as in the past if prices are lower. So what it means going forward, you've got a lower income elasticity of oil demand that implies flatter growth of oil demand even when economies recover from a recession. And we can talk a little bit more, and maybe it'll come up in the Q&A, we can talk a little bit more about how these elasticities became smaller now than in the past. But I'll leave that to the Q&A if folks have questions. So let's go forward and see what this might mean for the future. So now we realize that there's two trends that can reduce global oil demand after a crisis. Demand can reset at a lower level. It could take a step down, and it could also grow at a slower rate with this lower income elasticity of demand. So we have a downward ratchet that resets demand, but lower oil intensity means slower future growth. So what we have here, the yellow line, orange line, is actual global consumption of oil. And you can see with those dotted blue lines, so we had the oil crisis in the 70s, demand falls, and it starts to recover in 84, but that blue line is starting from a lower level. The oil demand did not pop back up to where it was before, and the trajectory of that line is flatter than the blue line at the top. So you've got a step down, and you're growing at a slower rate. And then we can go forward and say, look at the impacts after the global financial crisis, and we see oil demand fall there in 2008, pop up again a little bit and grow at a slightly slower rate than it was in the past. So again, you've got the step down, the slightly slower rate of growth. And remember, we saw that in the econometric results with the bars for the second period of the data, much shorter than the bars from the first period. And then, of course, here we are in 2020, and where are those red lines going to be? Are we going to recover some demand, but then grow at the same rate as in the past? Maybe. That would be that top red line. Are we going to recover some demand, but then grow more slowly in the past? That would be that bottom red line. We really don't know what's going to happen, but it does imply that peak demand might be closer than economists have projected before the crisis. And of course, that has impacts for oil company strategy. There were many different outlooks for oil demand. Some showed upward trends for many years to come. Some showed peak oil in the 2030s or the 2040s. But even before the COVID-19 pandemic, economists did expect demand to slow down and lag behind global economic growth. But now it might not only be slower, it might be stepping off from a lower stair step. So the impacts of COVID-19 and the lockdown have accelerated a trend that the oil industry would have had to face anyway, which is a slowing demand growth, which might drive industry consolidation or various oil company strategies. But rather than have this sort of gradual, maybe 10-year period to kind of retool, think about strategy, it's maybe more like 10 months than 10 years. And then just to think about the future as well, I think it was Mark Twain who said, history doesn't repeat itself, but it rhymes. I think that means that this time it's different, but then it's also the same. So if we look back again at our sort of our history lesson, we saw in the 70s and 80s that global oil demand declined owing to two things: high oil prices and a recession. But these high oil prices incentivized oil production, which is a good thing for the energy industry, for the oil and gas industry. And as the market rebalanced, the economy recovered, oil production increased. So you had a rebalance, lower oil prices, but it supported demand, and the high oil prices initially supported more production, non-OPEC production, as we talked about. But this time it's different because demand is down strictly on economic activity, not on high oil prices. So low oil prices aren't going to do much to help demand. Remember, the elasticities of demand are really small. The recovery of oil demand all depends on the economy and the structure of how we use oil going forward. So in the near term, as we've seen, getting the market back into balance depends on producers cutting back. We have to wait a while for economic growth to kick in for any kind of, for some substantial increase in demand. But I would argue that, again, history is rhyming. There's parts of it that could be the same. Once oil intensity declines, we've actually never really seen it come back. So I think that's the big caveat. And then if we turn briefly to implications for policies around climate change, economic development, geopolitics, we've got a cover from The Economist a couple weeks ago. The reset of oil demand can support efforts to, as The Economist called it, flatten the climate curve. Carbon taxes, they can be a source of revenue that the governments who impose them may use to help support other aspects of the economy. When energy prices are low, you can reduce fuel subsidies. That also helps government budgets, and they certainly need it if they're going to support economic stimulus. And then economic stimulus can also be in the form of government spending and investment, and some of these could be directed to, and some of them will be directed to, green energy technologies, renewable, et cetera, since they're going to need to provide some investment funds anyway to keep the economies from getting into a depression situation. And then we've got the oil-dependent economies. Some of them already have had long-term plans to diversify. If they have the wherewithal, they might fast forward such plans. One of these would be Saudi Arabia's National Transformation Program, looking at more use of renewables, for example, and other aspects of their economy they wish to develop. to become less dependent on oil. But then there's sort of the dark side. The ongoing struggles for revenue in oil-dependent countries could lead to more regional unrest. And if there's too much oil in the market, incentives to damage one another's oil-producing capacity and open up the market for more of one's own production. So that concludes the prepared remarks. I just want to make sure that you know where to find the article if you'd like more details. This is publicly available, and you can find it at the Social Science Research Network, SSRN, and that's at ssrn.com/abstract equals 3592443. And again, that's the Social Science Research Network, ssrn.com/abstract equals 3592443. So I want to thank everyone very much for their attention and turn it back over to Bob for any Q&A.
Okay, thank you, Marie. That was really a outstanding presentation. Very, very interesting. And we've already had a number of questions. I will remind the participants that to ask questions, go to the Q&A function, which I believe should be at the bottom of your Zoom screen. And you can add your questions to the queue. Let's just dive into the questions that are there. There's some quite interesting ones. One question concerned the increasing use in the petrochemical sector. Today we use more oil for petrochemical products. Is the demand for that sector going to influence growth? How does that work into your picture?
Mm-hmm. Well, that's a good question, and it's certainly true that we use more petrochemicals, oil for petrochemicals than we have in the past, and that's maybe a bright spot for the oil and gas producing industry. Traditionally, chemicals and petrochemical manufacturing is highly dependent on economic activity. It's very cyclical, but structurally, because what we've seen in the pandemic is an impact on transportation use of energy, whether it's gasoline or jet fuel, you can imagine when the economy recovers, there probably wouldn't be a dampening as impact on use for petrochemicals as there would be for transportation. So that might be a more, even though it's cyclical, any chemical demand goes up and down with economic activity, it might not lose as much structural ground as transportation use of oil has.
Okay, thank you. Here's one. Oil is not the only source of energy to fuel the economy. And during around 2000, the use of coal began to increase radically in China. How do other sources of energy affect the analysis of oil intensity and GDP?
So other sources of energy are really important because I was going to mention about how some of these elasticities changed over time. So, for example, we saw that price elasticity of demand for oil was much higher in the past than it has been now. That's because, for example, in the past, we used oil in the electric power sector. And we still do a little bit residual fuel oil, and in some parts of the country in the US. But one of the things that happened during the oil crisis and when oil prices were high is that we switched out of using oil in the electric power sector. And that was elastic, right? That responded to oil prices. So now that we have not much oil in most countries, not much oil in the electric power sector, it was replaced by coal, it was replaced by nuclear. Now there's a less elastic response. It's already gone. We picked the low-hanging fruit. There isn't a whole lot more oil to kick out of that sector. So absolutely, the use of other fuels and other substitutes is really important to think about how elasticities could play out going forward.
Here's a question sort of on the supply side. will OPEC, and this is from Suresh Chandra Sharma, will OPEC be able to keep production cuts at current level for a longer period of time? I think we're thinking about the break even for funding and national expenditures.
Mm-hmm, mm-hmm. Right, that's a good question. It's not so much for non-OPEC producers. It's all about the price of oil, the amount of debt financing that can be attracted, their future prospects, etc. It's more of a strictly economic calculus. But for oil-producing countries like Saudi Arabia, it's not so much the price of the cost of production, which for them is very low, but it's the amount of money that you need to fund at least your external balances. Economists have looked at funding for various aspects of, for example, Saudi Arabia's budget, Russia's budget, et cetera. There's been some very interesting and good analysis on that on the academic side. And folks have found that about $60 is ideal for Saudi Arabia to maintain its external balances. Russia apparently needs less. They used to need more than Saudi Arabia, but Russia devalued their currency and they made a few other structural changes, so they're actually not as dependent and they can probably tolerate a somewhat lower price than Saudi Arabia. So Saudi Arabia does have a struggle to keep prices where we think, we don't know for sure, but we think that their ideal budget would be in the $60, like Brent at $60 range. But if you have a large area of production, like the Permian Basin in the United States or the Bakken Shale in the United States, where they can break even at $50 or $40, keeping prices up at 60 is a struggle.
Here's another question from Suresh Chandra Sharma. He's asking about the demand decline due to countries imposing higher taxes on oil, perhaps for climate change reasons. How does taxation influence this picture?
Where you can see the biggest impact on taxation is if you look, I would say you would want to look country by country separately. So we had individual country data in our econometric model, but if you really want to look at the impact, I mean, and fundamentally a tax is just like a price, right? So if you see you've got a high tax country, you've got a low tax country, you can look at impacts on demand, but fundamentally it's just another price. So if countries now take advantage of the low price of oil and say, you know what, we want to get a handle on carbon, we want to disincentivize use of oil as a transportation fuel. With gasoline at $1.89, it's a lot, or that's at least near where I live, it's a lot easier to impose a tax, whether it's for reasons of carbon control or just beefing up governments, than when oil prices are higher. So it's a temporal thing, right? There's more room to increase taxes when prices are lower, and it's a country by country issue, but it's ultimately a price issue.
Victor Del Carpio Naira has a question that really follows up on that. He is particularly interested in how countries in Africa or India, for example, specifically, are affected differently than your global averages.
Mm-hmm. Well, it's interesting. We have a few non-OECD countries in our data set. What you often find in countries like that is that fuel is subsidized. Fuel prices are subsidized. So you wouldn't see a strong price elasticity, because even when prices are high, and many countries have gotten rid of subsidies, but for countries that still have them in place, demand is kind of artificially strong, right? Oil prices go up, and in the United States or other places, consumers see that higher oil price. In countries that have fuel subsidies, the government budget gets squeezed, or very often it's the energy companies that get squeezed. They have to buy crude oil at a global price. They have to refine it and sell it, sometimes at a loss. And that was going on in China for a number of years, and particularly in the coal sector as well, selling electricity at controlled prices, but having to buy coal on the market. So that can be destabilizing for governments, and it makes it look artificially like price elasticities are smaller than they really are.
Here's a provocative question from Bami Shenoy. Historically, econometric models have failed to predict the future. I think that's a pretty safe statement. What can go wrong in your modeling? And in particular, is peak demand going to come sooner than expected?
Yeah. Well, to answer the last part first, I think peak demand is coming sooner than expected, because think about the modeling that companies and economists, people who study the industry, people are doing. You have sort of a business as usual case, right? But we all know there's no such thing as business as usual, but you have to start someplace. And then you imagine these different worlds, right? You imagine a world of stronger economic growth. You imagine a green world, right? Shell has their sets of scenarios, and they have a scenario called Sky. And that's their world in which the world reaches its Paris targets, for example. And then you work backwards if you're thinking about scenarios like, okay, we're going to get there. What are the different ways we could get there? So to project, you don't just draw a line based on your econometric model. All those different drivers in the model, right? Prices, GDP, you have to imagine that world going forward and then use your elasticities. So what could go wrong? Well, you might not account for what we call like a black swan event, a surprise, perhaps one-off event. You could say the COVID-19 pandemic would be a black swan event. Now we know that any species could be subject to, a virus or a germ or some dangerous thing, but that's not a business as usual case. So this is a really good example of your econometric model might be good at predicting demand given, a normal world or a world with faster or slower economic growth. But if you really want to think about unusual worlds, you probably wouldn't apply just an econometric model. You'd want to think through all the things that could happen. That's called scenario analysis. So scenario analysis can be really helpful. What are other things that can go wrong? Well, you could have structural changes that weren't anticipated that change, the relationship between income, that changes the income elasticities. If you go back and look at, say, in the 70s and 80s, at a lot of the outlooks for oil demand, it was thought that the oil crisis was kind of a blip. And it was thought that oil demand was not price sensitive. It was thought that, well, everybody needs this and they're going to pay higher prices, and a lot of economists and oil companies, et cetera, and government agencies were projecting extremely high prices going forward. And in fact, many energy companies acted on this and continued to build refining capacity. So that was sort of an object lesson. And when you build something that's, when you build infrastructure, it hangs around a long time. Like, if you're drilling for oil and you stop drilling for oil and the wells kind of dry up eventually, but a refinery doesn't go away. So back in the 70s and 80s, the companies kept building refineries, thinking that people would keep wanting refined products, not thinking that the elasticity of demand had changed. And that led to an overhang of capacity that it stuck around the industry a decade and just, it just ruined refining margins. So I think you have to use econometrics, but you also have to use your imagination and just think about how different worlds could look.
Really interesting insights, yeah, from long ago. Robin Swank has an interesting question. He asked, based on what you've seen in trend for oil, what sort of trends would you anticipate for natural gas?
That's a good question. So if you look at sort of the gas intensity, at least for the US economy, that didn't do the same kind of stair step behavior. Like back in the 80s, there was a very steep decline in gas intensity of US economic growth. But back then, the gas industry was regulated and prices had gotten really high. And it was just, I mean, there were, congressional hearings about what the price of gas ought to be. It was just crazy. Eventually, the gas industry was deregulated. And, but this was after gas intensity of demand declined very, very dramatically. There was a steep decline in the 70s and 80s. And then it was fairly flat for about 10 years, till about 97, and then sort of a stair step down and a little more efficient, but fairly flat from 2008 to the present, which is actually surprising because natural gas has gotten really inexpensive with the drilling for shale. So you would think with all this inexpensive gas that the gas intensity of the US economy would have increased in the past 10 years, but it hasn't. Which is quite interesting. So what it tells you is we're using more gas, but not faster than economic growth. And of course, a lot of the gas we're producing is being produced for export in terms of LNG. So gas it hasn't behaved in the same way. Now we use it differently, right? We don't use it for transportation fuel. We use it for heating in the residential sector mostly. And we use it to generate electric power. So I think if you want to think about where gas is going to go, I think that's what you need to think about. There was a huge build out of gas-fired power plants when the electricity sector was restructured. I was going to say deregulated, but it wasn't really deregulated. So we'll say restructured. And it turns out that building a combined cycle gas-fired power plant, which is this interesting technology that started out as airplane engines, actually jet engines, was a very efficient way to use natural gas. And it was a lot less capital intensive than building coal or nuclear. And gas was cheap when they got started. So we had a huge build out. We still have that. Now the struggle for electric power is, the electric power sector is under the gun to reduce carbon emissions in many states, to a greater extent in more states than the transportation sector, and maybe California is an exception to that. So yes, gas has a future in the sense that it's much lower in carbon emissions than coal. Many, many coal plants in the United States have closed. But going forward, there's a very important push in many states, including states that are still regulated with traditional vertically integrated utilities, to build renewables and not necessarily fill the gap with natural gas. But if you're thinking about gas consumption in the US, I would watch the power sector.
Right. Here's a hard question from Kenneth Austin. And I'm just going to read this in some detail. A lot of the reduction of oil demand in the 70s and 80s was the result of substitution of coal and natural gas for fuel oil and diesel in electricity generation, heating, and industry. This structural change has run its course in OECD. That's certainly true. Oil is now mostly a transportation fuel. We see the slow advent of electric vehicles. Are there other structural changes in view of some similar magnitude?
So similar to electric vehicles in that it would replace a lot of oil demand, I think is what the question is.
Well, I'm not sure exactly how to interpret that.
Yeah, I think that, it's a good question because
interpretation of this question.
Yeah, well, I think it's a good, as we mentioned too, the pushing out of resid and fuel oil in the electric power sector was a big source of the response to high prices. And here it's not necessarily a price response. Electric vehicles are, we're not adopting electric vehicles because oil's too expensive. We're adopting electric vehicles because we have concerns about emissions and carbon emissions. So is there something on the horizon like electric vehicles that could, it may be this telecommuting. It may if there's a big push, if folks kind of say, yeah, the economy's opened up, but I don't really need to go in the office. My colleagues who have young children are looking forward to going back to the office. Not that they don't love their families, but I think it's a struggle to focus. Whereas The folks who don't seem to be pretty happy, telecommuting and using platforms like Zoom. So that may be, and it may take a few years to catch on, or it may catch on right away. And it's hard to say. I think it also might depend on how quick there's a vaccine where people are comfortable with getting on planes. But so telecommuting combined with EVs, that could be where the step change comes from.
Yeah, here we are. Instead of attending a USAE meeting, we're sitting at home.
Yeah.
Here's kind of a broad geopolitical question from an anonymous attendee. Could you please comment on strategies for countries that depend on oil revenues for their economic vitality?
Well, I think what we saw Russia do, which was interesting, is devalue their currency. So I'd say they made a conscious effort to be less dependent on oil exports. And at least, maybe they're not totally independent, but it's like if a bear is chasing you through the woods, you don't have to outrun the bear, you just have to outrun the other guy. So, they don't have to be that economic, but if they can take a lower price than someone else, if they can take a lower price than Saudi Arabia, it gives them a little more room to move. So I think in the near term, there's obviously things that countries want to do, for example, develop their other industries. Like I think part of Saudi Arabia's national plan was to develop, and maybe still is, to develop their tourist industry. And they've developed renewables powered electricity, et cetera. So there's structural changes, they take a little longer. I think near-term changes are, working with their budgets. And again, Russia's a pretty good example of getting out from under this a little bit.
Gurchin Gulen has an interesting question, sort of opposite to the way most people are thinking. He points out that if Africa starts developing its economies more rapidly, how do you think this would impact oil demand? Would this be a potential big turnaround when you have 1 billion new consumers who today, as he said, hardly even enter the data?
Well, that would be a driver for higher demand. So you could see growth. Presumably those economies would go through a manufacturing and maybe an energy intensive stage, like the rising Asian economies did, decades ago. So yeah, that could turn things around. It's something to watch.
I think I'm going to take the privilege of asking the last question. Some analysts believe that COVID-related recession will be a V-shaped, short, sharp shock. Others think it might be U-shaped and extend for a year or more. How would these scenarios play out in the medium to long-term oil demand along the lines that you've analyzed?
Well, I think if you have so let's say you have a quick recovery, you can have the economy recover, but you could still have people, say, telecommuting. So the economy recovers quickly. The economy recovering quickly kind of assumes everybody's going to restaurants and everybody's going to conferences and everyone's getting on planes. But still, I think people with, the preference and the ability to do so might not get back in the cars and, sit on the Mass Pike for an hour and a half to get to work if they don't have to. But it would still impact demand. And then think about a long drawn out situation, that would keep demand it would dampen demand lower longer, but I don't know if it would be I think the structural changes might be about the same. So you have the economy slowly recovering, the structural changes are still in place, right? There's fewer people on planes, et cetera. So demand is lower, but I don't think it's the length of the recovery. I think it's the structural changes that are going on behind it that probably matters more in the long term.
Interesting insight.
That was a tough question, Bob.
I think that ends the hour. I'm going to turn it back to Dave Williams at the USAEE for some
Thank
final
you, Bob, and
comments.
thank you, Marie, for just an outstanding webinar. I've really, really enjoyed this, and would like to invite you both back for a repeat performance. You know, one thing that is certainly true in these COVID times is that the research that is done now will be different in just a matter of weeks and months. This webinar will be available on USAE's website this afternoon for any of you that would like to share it with your friends and colleagues. If you're not a member of USAEE, we invite you to join us by visiting www.usae.org. Thank you for attending, and I officially close this webinar.
Thanks very much.